might forget.
So with that, Madame?
Okay. Chair?
Here.
Controller's Office?
Here.
Public Advocate's Office?
Here.
Borough President Manhattan? Borough President Brooklyn? Borough President Queens?
Here.
Borough President Staten Island?
Present.
Borough President Bronx?
Here.
International Brotherhood of Teamsters?
Here.
Transport Workers Union?
Here.
District Council 37.
Here.
We have a quorum.
Madam Chair, I'd like to have the record note that Mr. Tanyo is not here because he's in Philadelphia at Wharton
Ah, okay.
taking his course in
Very
pension asset management.
excellent. Continuing ed program. Larry?
Okay, so let's go through the monthly performance results. Hopefully everybody has them. Not sure if we have extras today. Do we have extras?
Mr. Gaines is on his way.
Okay. They're all in the book in any event. Save paper. All right.
Thank you, Ted.
Starting on page 2, just as a quick overview, what seems to be going on is the economies are slowing down. You'll see that as a continuing theme throughout some of these economic charts. It's slowly getting reflected in the markets, to be continued. You can see it graphically on U.S. GDP on page 2. You can see leveling off on page 3 of capacity utilization. On page 4, you can see the manufacturing index slowly dipping a little bit. Weekly unemployment claims, again, it spiked up, but I think the trend is probably down. But again, if the economy slows down, it'll stagnate. You can see unemployment dip back up to 9%. Consumer sentiment bouncing around a little bit, but generally positive. Architectural billings, you'll recall, is a precursor of construction. That leveling off is not a good thing. We'll pay a lot of attention to that going forward. Page 9, you can see existing home sales. Again, low level. The biggest problem is actually on page 10, which is new housing starts, no construction because of the overhang of homes due to foreclosures. Retail sales, I can't tell you why it spiked. I have no idea, but again, I think they're pretty consistent at 3.5%. Auto sales have leveled off a little bit. Leading indicators are still going up. I think that's partly due to some of the financial things that were going up through March. My guess is that'll level off a little bit in the future. The CPI is going up. Food prices are going up. Price of oil is going up. If you look at what happened in the markets, page 16, the euro got ahead of itself. It's now coming back to more normal levels, about 140. The opposite is true on the next page, the dollar. What you'll slowly see creeping in the markets is a little bit of fear, which I'll talk about in a second. Page 18, LIBOR is flat. That's good. The volatility index is the equity markets fear index. A little bit of bounce, but again, not too much, except for the last week or probably the last 3 weeks. The yield curve, page 20. The white line is a relevant line. What you can see on the front end of it is it's basically flattening out. No one knows what's supposed to happen after the Fed ends QE2 in June. Bill Gross at PIMCO says, throw out your government bonds. BlackRock says, good time to buy your government bonds. So who knows? But the answer is rates are low, they're staying low. You can see this on the next page, page 21. I call this the bond worry index. People had gotten comfortable with the 10-year Treasury around 3 and going up to 4. Instead, it's broken down to about 3.15. That's fear. Fear of a variety of things. Fear of what's going on in the Middle East, fear of what's going on in Europe and the EU, fear of the economy slowing down. But again, very low. You can see on page 22, high yield market, the yields were tightening and they've sort of plateaued. You may recall we sold some high yield bonds. You might sell some more a little bit here. And the spreads of investment grades have also plateaued. Corporate earnings on the next page on 23. That's the blue line. They're going up. This is the S&P 500 PE. It's about 13.5. Not very expensive. Page 24, you can see the world indices, the Russell 3000, IFA, and emerging markets, also all of which are not very expensive, particularly on a projected PE basis. You can look on 25, large cap, mid cap, small cap. Small cap is expensive. I would caution everybody about the internet bubble that's back on these hot new IPOs. Not a good sign, in my opinion, because bubbles pop, and that'll be ugly. The good news is the doctors and dentists haven't been allowed to buy them yet because only institutional investors have been able to buy them. But again, not a very good sign. Page 26, you can see the volatility. Again, this is a March report, if I'm not mistaken. This is March, and if you roll your eyes back to March, there's a dip right where it says March 11 March. That was the tsunami and earthquake in Japan. The markets collapsed, then the markets rebounded, and now there's a lot of volatility in the markets now. People actually worry, I guess, probably about Greece and the euro and things of that nature. M&A activity continues to be robust. That's good. That's CEOs being confident and using some of the cash on their balance sheet. Page 28 shows you NYCERS for 8 years. As you recall, we take about $2 billion out of NYCERS, so $13 billion has been taken out of NYCERS during this period of time, but we're up. In fact, if you look on the next page, 29, we're pretty much at the high point of the last 12 months. In fact, it is the high point at $41.1 billion. Page 30, you can see the asset allocation. Again, we're leaning into equities. We're leaning out of fixed income overall. And again, we're most underweighted in real estate, and the proceeds get put generally in the equity markets. If you look on page 31 at the bottom line, we're again 71.7% equities and 28.3% fixed income. On page 32, we had a good month in March. Again, despite, you may recall, again, it's the problem with having a meeting in the end of May, talking about March results, is you have to scale back your memory. A lot of things went on in March. The tsunami went on in particular. Markets were very volatile, but coming out of that, we still made 1%, which is very, very good. Our managers did well. The asset allocation held up well. We made money in the U.S. stock market. We made money in emerging market stock market, and we made money in private equity. Recall the private equity lags, and that these are really year-end values rolling through the private equity valuations. So again, a good month in March. We had probably a flat month in April. And we'll see what happens in May because of the volatility and declining stock markets. For the year, we're up almost 22%. My instinct is we won't hold that. I think stocks will go down between now and the end of our fiscal year. So I'm not sure what the final number will be. Stay tuned. But the 3-year number, which includes the crash of 2008, is now up 4%. So we made back the money, plus some. So I think we're actually in a very good place. If you look quickly at the indices on page 33, you run your eyes down the top 2 blocks, you can see the stock markets basically ended up flat. And we made a little bit of money in the bond market. Just to give you a teaser going forward, on 34, the markets rebounded pretty nicely in April. So again, I think April will be up, but I think we gave a bunch of it back this month. So we're probably about where we are now at the end of March, is probably where we are now, if I had to just sort of project forward. The rest, as you know, are all the manager reviews. Next month we have a quarterly report, so I'll skip the manager reviews just to move the agenda along. Again, all the managers, in general, the managers held up very, very well in March, so we felt pretty good about the entire portfolio.
Larry, do you always do the quarterly report at the 3rd month of the quarter, or is this delayed?
As soon as they're ready.
Is this a little later than usual?
That?
Kind of on the ball. So I wouldn't call it late. We're sort of in between on dates. So the plan is that we will do the quarterly report for the June meeting.
If we had them.
Yeah, but I'm
Chair.
wondering if it's just 99% in but not 100, or I guess we wait for everything.
Couldn't tell you. Again, what's odd about in June, we're going to talk about these numbers. because this is the first quarter. It's right here. You can see it's the trailing 3-month numbers on this page.
Yeah, that's what
are
I'm
the
saying.
three
It
quarters.
just seems
It's just it's a holdover from the way it was done. So
something
we
we
might
can
come
look
up with,
into, maybe?
we might come up with a quicker way of doing the quarterly report. Again, the quarterly numbers are the third column, of the second column right
Yeah.
here. So, but again, the bank does a nice job packaging the quarterly report. But again, speed is not.
Timeliness matters too, right?
Speed is not their strength. But these are again, by the time we do the quarterly report next month, we'll be staring at the April numbers. So they're out of date. Any more questions on this?
I guess I have two questions on asset allocation. The convertible bonds is in the policy, but when we get to the asset allocation, we'll note that it wasn't included, so I'm a little surprised. It shows up here as policy.
I'm sorry.
Yeah, I mean, I think we talked about convertibles and at a 1% allocation, we simply don't model it, or recommend not modeling with those small numbers. I don't think there was any plan necessarily to do away with the allocations we currently have to convertibles. That wasn't included in that as a recommendation. It just wasn't a set of asset classes model.
Okay, and then what is the emerging managers and NYCERS? Who do we have?
Do you want to wait until the next topic, which is
No,
emerging
it's
managers?
just a policy question. Is it equity or fixed income? Because we
Both.
count this, but shouldn't the equity be in the equity piece? We're counting
What page you on?
your allocation page, 31.
That's only something.
31.
I think this is just doing something. One small number.
Yeah, that actually, I'm not.
I think
certain of.
what we've tried to do on these is actually merge them into where they belong, because they're a little small.
But I just would hate anything that's fixed
I think
income to
it's-
show up,
think
equity to
it's-
show up under fixed income.
I agree with that.
Okay, all right.
We'll fix that.
We- yeah.
If that's the equities, we'll fix it. Good point, Ron. Okay? All right, so let's talk about the emerging managers in detail. SEMA?
Yeah, so we're just passing around the color copies for everybody.
Different.
I'm okay. Yeah, I don't need it. I don't need it. Thank you.
Might be one of the, just let you know. Just
Okay, everybody has one? Okay, great. So, we wanted to just give you a broad overview of the Emerging Managers Program and offer up some recommendations, in particular, getting your vote on issuing an RFP. And we had talked about that before, so we wanted to come back to you with some detail around that and a couple of policy-type issues we've been working on as well with respect to the program. So if you turn to slide 2, this just talks a little bit about what is an emerging manager. We've defined it in New York City as a manager that is small in terms of assets under management in the sense of not being able to be a standalone mandate yet for New York City. We've also defined it as a manager where once you reach over $1 billion in firm-wide AUM, we would look to try to graduate you from the program and you would become more of a developing manager. So that was one definition that New York City had put in place. And also, NYCERS has elected to invest in emerging managers through what we call fund-of-funds, and these are managers of managers. And on slide 3, we give you a little bit of history as to how NYCERS has invested. And NYCERS, different from the other systems, has elected to invest in multiple asset classes. So not just U.S. equities, which is what the other systems have done. NYCERS chose to elect in U.S. equities and emerging managers, fixed income, as well as EFA, so non-U.S. And you can see the history here and the amounts that NYCERS has invested. In the bottom section here, as of November 2007, which was the last time an RFP was issued, You can see the total amounts there for U.S. equities. And again, if you add in what NYCERS has done in fixed income in EFA, and that has been primarily with Progress Investment Management, the dollars are over $300 million. And just to note, down below here, you might remember we terminated Bivium Capital, and at the time we did that, that was $46 million in market value. And we also terminated, you might remember, Lombardia, which is a developing manager, and at the time of termination, that was $107 million. And so total in terminations was $153 million. So as we think about an RFP and issuing that and opening up more opportunities for emerging managers, many of whom are minority and women-owned businesses, we would look to at least try to replace that amount of money. If not, if there are more opportunities with good managers, consider investing more money on top of that. To turn to the next slide 4.
What percentage of our total fund does that represent, $7 million at this point?
2%.
About 2%.
840.
Huh?
842 million.
It's, yeah, about 2% of your total.
So I'm confused because the policy showed 0.4% and 145 million in emerging managers.
That was fixed income. If you remember in the policy in the IPS, it's 2%-ish roughly.
Okay, great. And,
I see it.
that's going to be our target at the end of our asset allocation process.
Well, so it's about 2% of your U.S. equity manager or managers is about 2% of your total pension fund. To Rundy's point, you add fixed income in there, and now you're getting a little bit over 2%, which is in your policy range in the IPS. So
I think, though, to the point of how much you have, I think this represents only the emerging manager program. So remember that.
That's right.
That it doesn't include other emerging managers you have as direct allocations, emerging managers you have as direct allocations.
correct. So it doesn't include the developing managers. That's right. If you turn to the next slide 4, this gives you the current market values across each of your manager or managers. And so you see the total there being roughly $800 million across asset classes, across your emerging manager and managers. Slide 4 shows, slide 5 shows the U.S. equities performance of your managers. And if you scroll down to the last row here, 2010, so $620 million. And if you scroll across toward the far right, you'll see a column, excess returns since 1993. And you'll notice here that, so you're underperforming by 89 basis points through 12/31 of last year. Through March of this year, the underperformance is 85 basis points, so a little bit better since then. But nonetheless, the underperformance is about 85 basis points, although in the absolute return column right next to it, they are making money for the program.
How does that compare, that underperformance, to U.S. equities, non-emerging managers? I mean, are we making money with this group? Are we losing money with this group? What's
No,
the
so
opportunity cost?
Right, so that column to the left, which is absolute return, is you're up 7%, so they are making money.
That's not my question. My question is, how does it compare to, we have a special program for emerging managers. I'm asking, how does the return on that investment program compare to what we get someplace else? Do we do better here? Do we do worse here?
Well, I don't have numbers going back to 1993 specifically, but if you go back to your monthly comparison report and you look at your U.S. equities, and we've got trailing 5 years and trailing 10-year numbers, and yeah, so page 36, you can see active domestic equities since inception is the far right column is 10.36%, and that's all of it combined. And then we'd have to break out, large cap, mid cap, small cap in your active, because you don't have as many active managers as some of the other systems. You have mostly passive management in your U.S. equity portfolio. So we'd have to break that out for you.
So we don't
To
know.
answer your question, on page 36, and assume that this is only about 20-25% of your active, the 5-year and the 10-year are positive numbers. So look at the 10-year. 10-year is plus 43 basis points. This page, which is 10-plus years, is minus 89 basis points.
You have to orient me on this.
Sure.
Where-
Page 36,
Right.
equity asset
Right,
class.
Right,
The second line, active domestic equity.
okay.
10-year trailing is 10.56%. The Russell 3000 is 4.13. The value added of your managers is 43 basis points.
It's positive.
It's positive. There's a dramatic shift in the emerging managers in the last 4 years. I couldn't tell you what happened, but they've made money for us the last 4 years. Before that, they did not do very well.
We added on more managers.
The reason I'm asking is, jumping forward, you're recommending an increase to $2 billion for,
No, that's a policy recommendation, which is, right now, we define an emerging manager as a manager that it has assets under management up to $1 billion. Once they go over $1 billion, then we want to have them develop and graduate. And what we're suggesting now is, given conversations that we've had with Mark Klein and Callan, all of the managers, and given the fact that the markets have been up as much as they have been, many of our good managers are now hitting up to the $2 billion mark, and so we don't want to have to fire those managers and move them out of the program. Because really right now, and we've been working with legal on this to try to make sure this does not happen, is that we've got contracts with the manager of managers, the fund of funds, not the underlying managers. So that if we wanted to graduate a manager once they hit over $1 billion, the only way to do that is to issue a new RFP. And so that's just a challenge that we want to try to fix. So that's a policy recommendation.
Larry, was your question answered?
it sounds like you make money with the group.
Not relative to the broader group.
Well, that was my question.
Right.
Relative to the broader group, we are making money or we're not making money?
We're not.
What do we lose?
No,
It's not clear. I thought- I thought-
you can't say that from the data.
Okay.
We don't have comparative, they have no comparative analysis.
So can we see that, please? Can we
Yeah,
see
you
if
want to
this
see
program
back
is
from
working?
1993, however many of your active
Whatever's an
managers.
appropriate, 1993 is just a year. I don't know where that fits in the cycle of life, is that the appropriate period?
Right.
I would be guided by, somebody with more expertise in it. I would just like to confirm that we're certainly not doing poorer in this area, as we try to promote, the ability of people to make money. I'd like that money to come to us, as much as possible.
If I might, one of the things that I think causes confusion at various times, I believe in the book with the numbers that come, I think primarily from Bank of New York, Mellon, the numbers are generally gross of fees before the management fees are taken out. I believe in the report today, you try to present numbers net of fees.
That's right.
And these are net of both the fees at the individual level and the fees of the fund-to-fund managers.
Correct.
So sometimes when you look at this, you just have to, this may have an apparent outperformance, but of course you just have to find out what the fees are if it's quoted before it, and then this one is designed to do that, so.
If you do an analysis for this, it would be possible to do both the gross and net.
Sure. Can do that.
So I guess there are two questions. One is, are emerging managers generally outperforming larger managers? And so what is the universe of emerging managers, and does our thesis hold? And the second is, did we pick the right emerging managers?
Right. I think
But those
your
are
first-
two separate questions, and I would really like to see an attribution of our program to understand whether it's working or not.
Yeah, one of the issues that we've talked about before also, and it applies here, is that these are you've chosen Russell 3000 benchmark managers, and we've found that Russell 2000 benchmark managers and some of the other systems have outperformed these managers. So as we think about issuing a new RFP, we should really think about hard the benchmark to which we want to benchmark these managers. And we can find managers, and through the scope that we're working on right now, we're including lots of different benchmarks to find managers who can create product, or already have product, hopefully, for us that they've shown a consistent track record of outperforming in these other benchmark type products. And right now, NYCERS has chosen all Russell 3000, all CAP products. And if you look at what we presented to you last year about this U.S. equity reallocation, moving away from large cap more into mid cap and small cap, where there's more excess return opportunities, we're not getting that necessarily right here, given the products that we've chosen. So that is something we're looking hard at as we consider issuing this new RFP and as we design the scope. And you'll all see that scope as we get the draft out, hopefully in the next week or so. So those are some of the considerations for sure.
So is there a way for us, though, there are two ways to find out, right? So one is to go into an investment and just look at managers with our size criteria and just see what the universe has done. My worry about trying to learn from an RFP is if the right managers, as you've impressed upon us, don't apply in the RFP, we won't know whether we missed good managers. So how can we find out, how can we as a board see and understand where managers add value to going beyond just our program? You see what I mean? So maybe there are large cap managers out there, I'm making this up, that do well, we just don't have them, so we may not do an RFP for them.
Mark, do I?
Yeah, I think you're dealing with a lot of different issues here in terms of this. And let me sort of address a couple of them and close on Ronji's point. Larry, to your question about how, in fact, these managers are doing relative to your other managers, I looked through the performance book, and there really isn't a consolidated how has this group as a whole done that you can then compare to how is the rest of our portfolio done. So there isn't an answer yet today, but in looking at this, again, I just, we don't do any of the work on this, but as I take a look at this, the way I would view this is that this program got off to a very difficult start. This emerging manager program. If you take a look at performance for individual years under that 1 year excess return from 1994 really through 2002, you see a lot of red numbers. The emerging managers up until then tended to underperform. Since then, and again, this is simply a benchmark comparison, from 2003 on, you see a blend, like what you might often see with many active managers, blends of outperformance and underperformance, but as you extend out into the 3 and 5 year excess returns, you see that there is some level of value added. And these we're told is on a net fee basis. Is that sufficient to justify an expansion of the program? That's part of the work I think you're going to get done. But I think I would look at this and say, we had a program, we are committed to the program. It didn't do well in the early years. Through some changes and so forth, it has improved, and obviously we look to improve it more. How much it has done relative to the rest of your program is something for the attribution still to be done. In terms of sort of, are you getting the right managers and so forth? I think there's two parts to this, and in this emerging manager programs where you've done this through RFP in the past, and I think going forward probably rightly would do this under RFP again. as opposed to a full-blown consultant search. The managers that are available in emerging manager of managers, I think, will respond to that RFP. There is a lot of emphasis placed on that. They're aware of that, so I think you'll get well represented. And so the process of then narrowing that down into the group that makes sense for the program you're going to have going forward, I think should work. When it comes to individual emerging managers outside of the manager of managers, then I think you can deal with that through the new process that we're unveiling, starting with the emerging market search.
I would add to that as part of the new process, as part of the RFP conclusion, I think to Seema's point, we should target them away from the large cap and target them to the Russell 2000, because that's really what smaller firms focus on, is emerging companies, if you will. It's much more value added. I don't think a small emerging firm is going to give us very much, if any, value added in Exxon versus Mobil.
Well, and it's a very reasonable point in the way a lot of these are developed, because you have two issues. You have not only can large cap managers add value over an index to start with, it's more difficult there, which is why you're as passively oriented as you are. And then the second issue is the firms themselves. Do they specialize more, and are they able to add more in small cap, mid cap, as opposed to large cap?
Is there a minimum size that we are concerned about? I mean, I have no idea, but is there a correlation with better performance towards the more recent period because they've gotten larger and therefore may have more research capability? I mean, it's a question. It's not a, I have no idea.
Yeah, and I think that is something that can only be shown through the attribution work that's done. I think some of it is certainly a result of the work that was done back 5-6 years ago to improve the program. It's shown better results. What we can't see from here is better results relative to what, where's the attribution coming in from, and so forth.
Larry, I would tell you, if you go back, I mean, this is a very long history, actually. I would tell you that the emerging manager business wasn't very developed when we started. We were probably cutting edge in '93, and now it's a real legitimate business. So when we have the RFP, we'll probably get 24 firms that apply. Some of which have a long record, some of which have a shorter record, but we'll do our analysis on that. But it's much more formal, official business than it was. So a little bit of, I think it was very good at the systems, did a new RFP, I guess it was in '07, '06. And then the returns upgraded, clearly something good happened there. And a bunch of firms have come out of some of this carnage, emerging managers. So I guess part of the reason for the search is to make sure that we're current on what's out there to get better managers. Hence the search.
A couple of things. First, I would love to see a breakout of returns over some period, if not the entire period back to '93, but manager of manager by manager of managers. I think that would be a helpful thing to see. Also, another question, what is our definition at this point of developing managers, and how much overlap is there now between our sub-managers in this program and the developing managers?
Yeah, so the way New York City had been defining a developing manager was a manager with assets under management of $1 to $5 billion. So now with this new recommendation of moving up an emerging manager to $2 billion, I'd like to consider moving up the developing manager to $2 to $5 billion. So it's, there are some good underlying, so these sub-managers within our fund-of-funds portfolios that are already over $1 billion that are doing well for us. And we just need to figure out a way to graduate them, because that's really the goal of the program, is to help them grow to be bigger and more successful. And so right now they're just still sitting in our fund-of-funds portfolios.
Do we have any?
Our program's not well structured. Because the way the program, at first there's overlap, developing in this. Second is, at $1 billion, it's not clear that you're ready to get out of our program, hence expanding it to $2 billion. And the way the contracting works is, once we graduate you, we can't give you a direct contract with us. So you basically fire the best guys we have by graduating them out of this, but there's no school to go to. Because to get a direct contract, you have to participate in an RFP. The way it ought to work, and what we want to work with contracting and legal on is, as part of this new RFP, it ought to work that you're in our program, you graduate, you get a direct contract with us. And you sort of avoid it. We don't need to have an RFP.
As a developing.
Yeah, you do get your own contract as developing manager because you did a good job, as opposed to you did such a good job we fired you, which makes no sense and completely defeats the purpose. But that's not how it's set up now. It's set up, you graduate and see you later, thanks for making us money, but you're fired. Doesn't make any sense.
And also, we don't have a mechanism yet where we could then reward the fund of funds manager for helping this great manager grow up
Right.
and graduate. We take the money and then there's a hole, potentially.
Right, so we should, once we graduate someone, they should get a contract direct with us, assuming that we like them still. So you need a little mechanism to make sure that works. But then we should give the developing manager the capital back, as opposed to the developing
fund of
manager.
funds.
Sorry?
The fund of funds.
The fund of funds, right. He did a terrific job. So,
So will we see all this in the policy?
yes. It'll all come through when we get to the end of the RFP. You say, all right, here's the policy, here's a new process, here's how we should do it. And again, we have to work with legal to make sure we can do that. Because it's not obvious yet that you can give someone a contract directly after you graduate. It should be obvious. It should be, in theory, we had a contract with him through a subcontract, but you'd like to think that subcontract should lead to a direct contract. So again, legal's working, our legal is going to be working with Corporation Counsel to make sure that works.
Yeah, that's a wrinkle in the procurement.
Right, that's a little wrinkle that you think, again, we should have something that works for us, but we'll just have to see if we can kind of make it so that maybe we're supposed to give them all subcontracts as part of being an emerging manager, so then you have a contract with us, and then we can make you go from sub to a real contract. But again, that mechanic has to work through the procurement rules, and as part of this process, we're going to work on that. But that's a very, very fundamental, in my opinion, gap in the way we have this program set up. It's set up to fire your best guys. Doesn't make any sense.
So if I can summarize a little bit, there are a number of questions on the table about the existing program and getting good comparisons in terms of not just the right benchmarks and at the fund of funds level, to Jackie's question, but also whether the overall program is working and how to think about it. And I will tell you, I'm still not sure how to think about it, because I think we need to come up with some way, and Mark, I'm looking to you to guide us, about what is the right emerging managers universe so that we can answer both levels of questions. One is Larry's question about whether emerging managers outperform other active managers, and the second is whether we are picking the right emerging managers. I asked this universe question because I also want to be
Or whether we pick the right,
fund of funds.
oh, no, whether we pick the right universe.
Well, exactly. So how do you define it is the question, right? And then the second element of the learning here is to make sure that is there any performance patterns, and in other places we've seen the best managers tend to be sticky. How do we know that when we select managers through this RFP process, we found the right managers? I just don't know how to think about it. So I would ask staff, between now and when we start seeing managers, we need more of a policy review along the lines of what Larry just proposed, for you guys to come back to us and let's look at the program. I think this is the first, I don't know when we last reviewed the program exhaustively, but that's what I think the board is asking for. And I think this came up at other boards as well.
Well, what we're going to do is we're going to start the RFP process, because some of the other boards have approved starting it, and we can continue this. Again, this process is not designed for speed. This is the old process. So unlike the innovative procurement that we're working on emerging markets, this process will take us 4 or 5 months. So during those 4 or 5 months, I would tell you that we're going to go through all these questions, work through the process, work through Larry's questions, which are good questions, work through the contract, so that when we get to the end, we'll be completely on the same page as to what it is we're trying to accomplish, so we pick the right managers to fit whatever the goals are.
And Larry, this search process that you're doing will look for managers who can manage against multiple levels of benchmarks. Also, it could be the Russell 2, could be the Russell 3, could be, whatever, through the process, what you do, what's defined also. So it's just like the RPs that you did for the, I can't remember the term you used when we looked for passive managers who could manage against any number of benchmarks. This would be the same thing here, which I think is probably...
Yeah, we might, exactly. We might come back and say, look, we think we should have an emerging manager for this, and for that, and for this. But again, before we get to that, we'll all get on the same page, hopefully, as to what those things are.
I mean, just a simple thing that shows us the universe of managers and what benchmarks they manage to and how they've done versus those, right?
That's why we included multiple benchmarks in this scope, in this RFP, because you're right, there are, call it 15 to 20, I think, emerging manager or managers, fund of funds out there in the world who manage across multiple products. And it would be up to us to decide which products we want them to manage based on how well they've done and who they are as a firm. And so that will be, I think, all in the selection process. I think for now what we want to do is open it up to the universe, which again I think is about 15 to 20 of these fund of funds, emerging managers who will have multiple products. And honestly, we put in an MSCI global benchmark, because I think there are managers out there who manage to a global benchmark, and we should consider those too. So I think historically we've just focused on, a narrow universe of products. U.S. equities, all cap primarily. And that's where a lot of the money has gone. And I think now we have an opportunity to really look out there for really new, high-performing managers across really good benchmarks that we would rather be in. So that's
a good way to summarize it, is pick the manager and pick the product.
Right.
Right? I think before we probably were a little less product-focused, more manager-focused.
So at the end of all of this, expect a full revision of the policy statement.
Probably.
That's right.
So as you know, I've already mentioned this at other meetings, my concern about going from 1 to 2 billion is it doesn't capture all of the asset classes. Fixed income scale is not 2, it may be 5. So I'm a little, it just seems like we're responding to what we have today rather than understanding what's out there. I'd love to understand out of the 15 people, not just the people we have today. I don't know if 2 billion is, you've graduated from anything at 2 billion anymore. I don't know where costs are in the industry for people to make money at 2 billion. I just don't know.
I think we'll find that out.
That's why I'm a little surprised to have a policy come out before the search. I'm just not sure. I think we're going to learn so much in the search. It's a little. Is it not premature?
I mean, the $2 billion was much more so for U.S. and non-U.S. equities. That we got confirmation of across the board. Fixed income, which is a smaller allocation in NYCERS, they don't have it in any other system. I don't know if Martin has any thoughts on that, but we've sort of thought that was a decent proxy. But I would say that for equities, U.S. and non-U.S., that $2 billion number is a good number.
And that was confirmed with the consultants. There's a break point there.
Right.
There's a break point in the market. But we'll come back with analysis.
Jimmy?
Can we confirm how other systems define emerging managers? You have like New York Common and California and all the many other. Be helpful.
Sure.
Just check see how the
can do
other
that.
folks define it.
Yeah. We'll come back with an exhaustive analysis.
Janice?
Everyone has a different interpretation. And we spoke to our emerging managers on that specific question. And most of them came back to us and said 2 billion is kind of the right mark. Some people go all the way up to 10 billion. Some are stuck maybe at 1 billion, and they look at other things besides size.
But Jimmy, we'll come back with that for you.
Janice?
Reasonable place to start.
So with regard to this policy, I'm looking at what I think is our current policy on how we define emerging managers, and we don't actually have dollar limits today in our investment policy statement.
No,
and I don't know if that was for a reason, so we could have flexibility over time. So are you saying that you think now we should change that and actually have hard dollar limits in how we define what an emerging manager is? Because we don't currently do that.
Okay, so I think the IPS, I read that too. It's lean on details. And so it's something that we will need to revisit as well.
Because now we have the flexibility, right? So we don't have to come back every year and say, now we think it's
So-
$2.5 billion.
So you're saying there is no $1 billion limit?
I don't see $1 billion.
There's nothing written in there.
I think
What is- why
It's
does-
written in the last RFP.
past RFPs have had limits.
Yeah.
It just wasn't, we didn't adopt it in the IPS.
Let us come back with the answers, all right? I think we got the sense of the room. We've inherited an IPS, and we'll fix it.
Do you need anything from us now, other than to proceed with the
Just to
RFP?
proceed with our, just to proceed with the RFP.
Okay, motion to proceed with the RFP. Do I have a vote? Second?
Second.
All in favor? Anyone opposed?
Aye.
Thank you.
Thanks.
Okay, now the pièce de résistance to the public session. We have asset allocation, which we've been working on since, I guess, the fall. And I'll turn it over to Callan. That hurts. Since you got here. Wage fall.
Anushka is handing out color copies of the presentation that was included in the agenda. So while she's doing that, most of you probably remember Jim Van Hewitt, who was here in February with us. Jim is in our capital markets group and has been, I would say, intimately involved in a lot of work we've done on this over the past 1, 3, 6, and 12 months in terms of developing the recommendations that are included in today's presentation. So as we get started, let me make some sort of introductory remarks. And as part of that, sort of take the board through some of what we've done, what we talked about in February, and then where we went and have gone since February to end up with what we and BAM are jointly recommending today as a new asset allocation policy. So if you remember at the February meeting, we came in with a presentation that's not dissimilar to what we have here. It was much bigger. It had a lot more information in it, but we used that as really a way to talk about the process of asset allocation, the history of capital market projections, which come to the heart of asset allocation, the development of the capital market projections that are being used in this analysis, and what I'll call, I guess, new considerations in asset allocation. We may, throughout this discussion, use the term optimization, which is really sort of a quantitative term meant to say we take all this information, throw it into a computer, and come out with an output. That's one aspect of asset allocation, but there's a lot more that goes into it. Fundamental type of analysis that gets to the risk tolerance of the client, the liquidity needs of the client, the issue of sort of where are you in your overall funding of your pension plan, and one of the newer things that's been talked about that has always been part of developing capital market assumptions, but I don't think has been given the same type of analysis, is something that I'm going to call economic diversification. The idea of what asset classes do well in different types of economic environments. That's always been part of the process, but I don't think it's been talked about or viewed or thought about by boards as much as it may be thought about in developing the assumptions. So I think at the February meeting we talked about a lot of those types of things. So at that time, we sort of took the board through a lot of different alternatives in terms of, all right, let's take you from conservative to aggressive type of mixes. Let's take a look at potential new asset classes. Let's take a look at expanding current asset classes. Let's take a look at how things do in those different economic environments or have done in different economic environments in the past.
So at the end of the February meeting, just as a reminder, here were a group of recommendations that we made for the board to think about. And the main ones were, first of all, we advocated diversifying the portfolio further. Now, that diversification would come in a couple of ways. It would be potentially adding some new asset classes. It would also be expanding the diversification you already have in some current asset classes, with the goal of helping to diversify the plan further and, in many ways, try and reduce the risk exposure to pure equity. So that's sort of one thing. We also talked about let's try and make further use of the basket clause. Presently, you're allowed basket clause investments of 25% of the portfolio. You're only using probably 15 to 18% of that currently. So we advocated further diversification by using more of that basket clause. But we also recognized one of BAM's thoughts, and that is that there is a goal at the state level among many pension funds to increase the basket clause. And so think about that over time, that basket clause may increase, and you will be able to use potentially more basket clause type of investments, which can help diversify further, so help meet some of those earlier goals. And then last thing, we said through the discussions that we had before the presentation and then after coming out of the February presentation, we talked about, we thought it was probably most appropriate to target a portfolio that has a targeted return over the coming 5 to 7 year period that is close to or in the range of the current targeted return of the current portfolio. So, in other words, let's not try and get a lot more aggressive. Let's not try and chase after return. But on a realistic basis, let's also recognize that we need to fund benefits. And there are risks and rewards and trade-offs and all of that takes place. So we came out of that with an expectation that what we'll be coming back with is a portfolio that attempts to target a return similar to what the targeted return of the current portfolio is, but improve it. So those are what we sort of came out with in terms of our recommendations at that point. Now, since then, both as a result of the discussions at that meeting, further work that we've done, and further discussions we've had with BAM and the board at the February meeting, we've narrowed down even further. And throughout here, we're going to try and focus in on some things. One is, again, you will see that the recommended portfolio is designed to target a return similar to the return of your current portfolio. So that recommendation we made back then has carried through in terms of what our recommendation is here. However, we're also recognizing that we're in, I don't want to use the word unique, but a different time for expected returns. With interest rates as low as they are, the expectation is interest rates are going to increase. That's going to lead to what might be called more equilibrium type of returns, normalized type of returns. And so that the portfolio that you adopt now as part of your asset allocation is one that we would see as the first step in a changing portfolio that changes as market conditions change and as your opportunities through increased use of the basket clause expands. So we're viewing this as sort of a logical type of progression. This isn't a finish it and stop. This is where it makes sense to be right now, given a lot of different things. Recognize, though, that there will be further changes at some point in the future.
Mark, fair to say that for most of your other clients, you do asset allocation at least annually, so you review it even if you don't change it?
I think, Ron, it really depends. I think for, and I'll let Jim, but I would say for large public pension funds, we do formal analysis that may or may not include a look at liabilities, but a really formal study, probably in a range of every 3 years, maybe 4 years, For various of those clients, we do every year a review of that, just to sort of put a stamp on it that, yeah, this still looks okay. So I think, Jim, any?
No, I think that summarizes it perfectly. We have long-term projections, so they migrate over time to reflect changing market conditions, and as they migrate, we review them annually to make sure that there's nothing happened, there's no dislocation in the market that would make the current asset allocation not appropriate.
All right, so then specific to the asset classes that we talked about last time, you'll remember that in February, we modeled a number of different asset classes. We have an additional one that we're bringing to you this time. We have one that we brought you last time that's now off the table, at least for now. So we're recommending new investments. At the end of this, you'll see we're recommending new investments in hedge funds, what are called absolute return. We've talked about that a lot. We're recommending continuation and, in some cases, expansion of your diversification in other alternative asset classes, such as real estate, private equity. We're recommending that an area called opportunistic fixed income, that you have some investments in currently, although not in the way that is modeled here, but an area of opportunistic fixed income as a new asset class. You've heard some of that as BAM has presented some things over the past couple of months, and again, further use of the basket clause by using all of those. So that's sort of where we were, what we talked about in February, what we heard from you all and BAM and the work we did, and where we're headed right here. So with that, if you can just grab a look at the presentation and maybe even start on page 1. I was happy to see that we had the time allocated to this that we did, because as Ranji indicated, this has been a lot of work over the past year by the board, by BAM, by us, and this really is the important policy that you've got to develop for now. So if you just take a look at page 1, again, I'm not going to cover an awful lot here, but I think what everybody has, in not only NYCERS, but pension funds across the country, consultants, et cetera, municipalities and corporations that have to fund pension plans, have really reacted to just how poor the capital markets were in the decade of the 2000s. I mean, if we think about it, the significant equity losses that took place, and we all remember 2008, which was really tough, but we have a tendency to forget 2001 and 2002, which were really, really tough. And so there's concerns about the exposure of the overall portfolio to that level of equity risk. And so, as we talked about, we want to try and help the system to the extent we can diversify away from some of that equity risk. We can't diversify away most of it. We can diversify away some of it. That's really where we're headed. So again, try and diversify the portfolio further, and again, the intermediate step, recognize that we're talking about this as an intermediate step. This that you adopt today may be something for 1 to 2 years, depending upon market conditions and the capital markets and the basket clause use. It may end up being longer than that, into the 3 to 5 year period, but recognize we view this also as step 1. Okay. Page 2, and I thought there were a few charts I thought worth bringing back from the last presentation in February. Page 2, if you remember, was what we tried to do is take a look at what were our projected returns for various asset classes over the past 20 years. And the takeaway you want from this is on the left-hand side of the chart back in 1989, if you take a look at the blue line, which represents broad U.S. equity, you see that when we did studies of this type back in 1989, we were projecting U.S. equity returns for the next five-year period of over 12% per year. Take a look at 2010, and as we've talked about, those are down to about 8% per year in terms of projected returns over the coming 5 to 10 years. With respect to fixed income, it's perhaps even more telling. The red line goes from over 9% projection back at that time to about a 4% projected return this year. And so, obviously, the projected expected returns for portfolios that are put together now are going to be lower than they were back at that time, and we've seen this over the course of this 20-year period, but this is an important consideration. You skip over page 3 because the volatilities have stayed pretty close to the same. I think page 4 is really an interesting chart. And if you think that as most public pension funds currently have something in a range of a 7.5% to 8.25% assumed investment return. What this chart shows is, again, going back to 1989, how much fixed income you could have in your portfolio and still be expected to achieve that 8% return. Back in 1989, you could have had over 80% of your portfolio in fixed income, and at least from an optimization standpoint, believe that you had a reasonable chance of achieving that level of return. As you see, going through the decade of the 2000s, that continually diminished to the point now where a 30% fixed income position is the most you could have in order to have an expected return of about 8%. So the natural result of that is on page 5, that you need a lot more equity in your portfolio to generate that expected 8% return. And since equities are a much more volatile or uncertain asset class than fixed income, you end up with a portfolio that's expected to be much more volatile. And you get that on the heels of returns and capital markets that have been much more volatile over this, especially this past 10 years. So again, we covered those last 3 pages or so at the last meeting, but I thought it was worthwhile bringing it back because it gets to, again, there's a return that this fund and other public pension funds need to make in order to be able to fund the benefits. You want to do that in the most diversified way, but the capital markets sometimes don't cooperate in the way that you want, and so all of that comes into play as we try and develop a long-term investment policy. That's not to say that you choose a policy that doesn't make sense. The policy you choose needs to make sense, but that may be more volatile than it might have been looking at it 15 years ago.
Mark, just to clarify, the graph on page 5 represents projected standard deviations for typical 8% mixes for all public pension funds, say. It is not consistent with the risk of this portfolio, which jumped to 70% equities in 1996 and has probably been up nearer the top throughout the entire period.
Jim, maybe you know exactly how this was put together. I think it was put together off standard normal asset classes.
Yes, these were historically, so what Mark pointed out in slides 2 and 3 in terms of the historical expected returns, that seems like a contradiction, but these are the projections that we came up with in these past years for both expected rates of return and standard deviations. We used those past projections to come up with portfolios that had targeted rates of return of 8%. So if you had asked us in, let's say, 1999 to construct for you a portfolio that had an 8% expected rate of return on slide 5, that portfolio would have had about a 10% standard deviation.
So it is not NYCERS specific, obviously, Bob, yeah.
Yeah, it would have applied to all of our clients.
Yeah. Okay.
Just so I understand, you're saying that page 2, that this is a 5-year projection?
Yeah, in the early years, probably up till about 2000, the projections we did were really 5-year forward-looking. They tend to be more 5 to 10-year now in terms of our assumptions.
And the reason I'm asking is because if 8% is the number for equities and 4% is the number for bonds, any asset mix with any bonds in it is going to produce less than 8%. And so then how do you square that with the idea on page 4,
Yep.
that 30% bonds
Yep.
produces an 8% return on average.
Yeah, well, I think a couple of things. One is there's different forms of equity that can play out. One of them is the sort of the volatility level of returns that play through. But for example, you're invested in private equity, which is assumed to return higher than public equity, and areas of emerging markets can help. But in general, and as we get to the bottom line here, you'll see that the portfolio that's being recommended to you is not projected to earn 8% going forward either. It's meant to, it's projected to return, I think it's 7.3, something like that. So you know, part of that is, that's exactly what we're telling you, that it's difficult to get to 8%, and maybe impossible even at 30% fixed income.
Yeah, I mean, part of this is a graphical issue. As I look at this now, it does look like equity is returning 8%. In fact, it was returning more like 9%. So you were allowed, you could have a weighted combination of these asset classes that would have an 8% rate of return. But your point really makes the point that is on slide 4, and that's that you know, over the last 7 years, let's say, in order to hit an 8% rate of return, you only had room for about 30% of more conservative assets, as opposed to, you know, in the early 90s, I mean, it was the other way around. You know, you had about 30% equity, and the rest of the portfolio had more conservative assets. It's not hard. It is much harder today.
Yep.
And it's harder for everybody. And let's talk about that on slide 6.
Before we go ahead,
yes,
I had a
please.
question. We're looking at the projected return. How close was it to the actual return?
Yeah, and you know, clearly that is time period dependent, but as you look at these projected returns, and you think about the returns that we received in the equity market, you know, in the decade ended, you know, 2008, 2009, 2010, you know, we had projected returns that were substantially greater than what was realized. I mean, because equity...
I don't mind if they're greater. It's the other way I don't mind.
Well, no, this is what
you do
mind.
mind our way, Pat. What you do mind what Jim's saying. He's saying the results you got were less than we and other people projected. And that is part of the risk of asset allocation takes place. I think Jim would probably point out that while we project a return, and I think equity is what 8% we're projecting. I think that 8% that's the median scenario. That's not a predicted scenario. What we're really doing is measuring, okay, around that, there are ranges that are expected. So part of the real issue is how comfortable are we that we even get the ranges right? And I think statistically they work out well. But remember, this is not a prediction. It is the best, working with all the information you have and the client and the projections you do. It is your best, I'm looking for a word besides estimate, because that's not the word I want to use.
Yeah,
your best projection of what type of portfolio, diversified, makes sense to accomplish the goals of your client. That really is where we're headed here.
So Pat, because there is no satisfactory answer to your question, what you'll see in the deck is you've developed a whole bunch of other ways for us to think about risk and return.
Yep.
Because these are just point-in-time estimates, and 10 versus 2.5 is a big difference, right, as we realized in the last decade.
We're going to show a lot of that.
And let me put it just a slightly different way, is that, you know, the 8% was an expected rate of return through the standard deviation, through the volatility that Mark was referring to. We said that there were lower probabilities of lower returns, but it turns out that one of those lower probabilities is what actually occurred. As a result of that, you and other funds like you who had funded, and it's important to think about this too, as you look at the gradual decline of returns, people, I think, gradually moved into more and more equity. I mean, it was not like they moved from a 30% fixed income allocation with, or excuse me, a 30% equity allocation with 70% fixed income, and then flipped that around in a single year. It was kind of a slippery slope down into more exposure to equities in order to meet the expected rate of return that we need to fund the liabilities. And I think that with 2000, as Mark referred to, 2000 through 2002 was kind of the initial wake-up call. 2008, because of its depth and its rapidity, was the real wake-up call that what we've done and what many funds have done have pursued this return with perhaps not as much of an eye to diversification as we might have. And so now we're going back and we're reconstructing the portfolios, we're reconstituting the portfolios, looking for opportunities in other areas such that when we know that markets are going to do poorly at some time in the future. How can we minimize the risks or minimize the exposure to equity markets when they're going to do poorly? And that's really what this is all about. This is less, I think, an exercise in pursuit of return and more an exercise in pursuit of diversification. Now, so as I mentioned on slide 6, we are essentially that summarizes what Mark mentioned before. You and other funds have moved on to more aggressive asset mixes in an attempt to squeeze more returns out of markets. What we're looking to do now is to mitigate the potential for losses in the future by moving into more diversified asset classes. And as Ranji mentioned, we wanted to do this in a number of different ways. Mark had alluded to the fact that asset allocation can be a highly technical mathematical exercise, but there is some intuition to it as well. And I think that's the way that we want to start into presenting this analysis to you, is that over the next 5 slides, we'll go back historically and say, when equity markets, public equity markets have done poorly, what asset classes have done well and what asset classes have done kind of an intermediate return in between those of equity and fixed income. So we begin that on slide 7. And this is one scenario when the equities did poorly. It's the 87 stock market crash. Notice that, that certainly was a major event, but it only lasted really for 3 months in the latter part of 1987. So a very sharp drop followed by a recovery. Last time when we showed you graphs of this nature, we looked at the peak to the resulting peak after the trough. Now we're actually looking at the peak to trough situation to show the magnitude of the losses that occurred.
And this is something you're going to see consistently we're going to do throughout this morning, is we're going to, the idea here is, what is the worst case? I mean, how much downside, part of your decision is how much downside can we tolerate? Because if you can't tolerate that, then you'll never get the upside. So part of what we want to show throughout is what was the worst case scenario across the board. So at the peak to the bottom.
And when we're removing that risk, to the extent that we want to remove it, what asset classes should we explore? And so the equity is always going to be, publicly traded equity is always going to be on the left side. Asset classes that tend to have returns intermediate between publicly traded equity and fixed income are going to be in the middle to the extending to the right-hand side. So you can see in 1987, for those 3 months ended November 30th, the U.S. equity market was down almost 30%. The non-U.S. publicly traded equity market was down about half that. To the immediate right of that, the red bar there, is the broad investment-grade fixed income representative for which we had data back to 1987. In this case, it's not the Core Plus 5, which is your benchmark, but it's the now Barclays Capital U.S. aggregate, but fairly close to the Core Plus 5. You can see that had a positive rate of return. I would also point out the 2 bars over the gray-colored bar is a representation of the NYCERS index, which is a representation of how open-ended core real estate funds performed, and that was also positive. If you look at the purple bar here, that's a representation of long-short equity hedge funds. They did poorly. I kind of want to downplay that bar, though, because this was very early, I think, in the hedge fund life cycle, and there are not a lot of managers in our database at this point, so I'm not sure that that's representative of what we would think hedge funds would have done in this situation had it occurred more recently. And finally, private equity, you can see on the right-hand side, the blue bar was down, as was public equity, but not down nearly as far. And that's a function both of the investments themselves, but also the way in which they're valued. As Larry pointed out earlier in discussing the most recent performance, it takes a while to value private equity. It does not occur on a daily basis like public equity valuations do, and that tends to mitigate some of the volatility that's actually realized.
It's actually worse because this was, in 87, they had different accounting rules. They
Right.
kept everything at cost. Now at least they're marked a little bit to market because of FAS 157. So this at least will move around more than it did in the past.
It will,
Hopefully.
yeah, if we're marking the market properly, but there are still issues associated with marking the market. So I don't believe, and correct me if I'm wrong, Larry, but I don't believe that we would expect it to be as volatile as public equity.
You're right. It shouldn't be as volatile.
So
at least not as marked.
At least not as marked. And so the pattern continues throughout the next 4 slides, beginning on slide 8. We're looking at the beginning of the first Iraq War. We had a 5-month retrenchment in equities, with U.S. equity down about 16%, non-U.S. equity down almost 10%. Again, we have investment-grade fixed income up almost 4%. Real estate is about flat, and we actually have a modest increase in private equity. As you look on slide 9, we now move to the collapse of long-term capital management and the Russian debt default in 1998. Notice also that there are more bars in this chart. We've now included TIPS because they've been available in the U.S. since 1997. We've also included CCC bonds as a measure of distressed debt, which might be in an opportunistic fixed income portfolio, as well as emerging markets bonds, also a measure of something that might be in an opportunistic portfolio. Again, U.S. equity and non-U.S. equity down together, but investment-grade fixed income up 1.84%. TIPS recently added in this into this graph also has a positive rate of return. Those bonds that are more credit-oriented have a negative rate of return, but something that's generally in between the returns that you would get from less credit-oriented bonds and pure equities. Notice emerging markets did exceptionally poorly. I think the reason for this is a function of really 2 things. The Russian debt default, which, remember, Russia is an emerging market and certainly was in 1998. And also this is, although we've pointed out the long-term capital management debacle and the Russian debt default, this is the tail end of the Asian contagion. So Southeast Asian markets did exceptionally poorly, and that's reflected in these numbers. On slide 10, we move to the tech bubble, and this really starts to get into what Mark was talking about in terms of your pain tolerance, your ability to withstand losses, because you can see over the 25 months ended September 30, 2002, both non-U.S. and U.S. equities fell by more than 40%. At the same time, once again, we see this pattern where investment-grade fixed income has positive returns, and in this case, exceptionally positive returns. More credit-oriented bonds don't share those positive returns. Real estate is, once again, up, and in this case, double digits. Just as I had a caveat about hedge funds in 1987, I have somewhat of a caveat about private equity during the tech bubble. This is a broad-based private equity benchmark, which means that it also includes venture capital. And if you recall, at the end of the tech bubble, venture capital made up a large proportion of private equity. And when the tech bubble burst, it did particularly poorly. So that's why private equity did so poorly, almost as badly as publicly traded equity over this time period.
I was wondering about Enron and WorldCom and those debacles. Is that roughly the same time period, or did that come?
That is, and that's an excellent point. And that's one of the reasons why more credit-sensitive bonds did so poorly in this area, is that around the time of Enron and WorldCom, around the time of Sarbanes-Oxley, I think there were it was widespread concern as to how much we could trust financials that were coming from corporations.
I'd just like you to give them some credit.
To note that their contribution to the losses associated with these markets, absolutely, that's the case here. And hopefully accounting has tightened up that we can avoid those in the future, but that certainly was a prime contributor to these types of returns. And then finally, the most recent equity market decline we have listed here as 2008, although it extended beyond calendar year 2008. And this was, as Mark pointed out, a very painful time period with both U.S. and non-U.S. equities in terms of, in dollar terms, down more than 50%. Once again, we have investment-grade fixed income in positive territory, both on a nominal basis or nominal bonds, as well as Treasury inflation-protected securities. The TIPS were also up. And we have, again, credit-oriented bonds down. Other markets, real estate, hedge funds, private equity, displaying returns that are in between those two, so offering some diversification to the portfolio.
I think one of the things as I go through these and I take from it is that, first of all, each of these time periods, these were, I think, looking back for those of us that have been in the business this long, were 5 keynote times when it felt really painful in the markets. And I think obviously there are different lengths to each one. One that lasts 2 years, as it did in early 2000s, or 16 months recently, are things that you can react to should you choose. The others in the 80s and 90s were 3-month time periods. I mean, they were sort of flash things that took place. But I think each time period has different characteristics, and in each one, I think there were some themes. One is sort of broad, safe U.S. fixed income was helpful in all of them, and helpful to a large degree.
But you have to qualify that and say high quality.
No, high quality is correct, Raji.
Because to call something fixed income just doesn't do it anymore.
And that was to get to the second point, that you diversify some of that already. We're looking to diversify it further, and we believe in that, but recognize that some of those have some characteristics when in fact they also in the past have gone down in these types of cycles. No, not as much as equity perhaps, but still go down. So they are diversifying and they help. They don't cover everything. So again, what we want to do is make sure we sort of manage expectations as we see them throughout this. Also, we think that what we're coming forward here, we're recommending, we think makes sense, but making sure you understand it's not a panacea. Okay.
And maybe another way of saying that is, if as is being proposed, to source the opportunistic from equities, you're actually reducing risk without giving up too much return. But if we were sourcing it from fixed income, it would actually be going the other way. I mean, from high quality fixed income, it would be increasing the risk, right?
Correct. Yeah.
Which is not on the table, to be clear.
And I think one other thing that is important to point out is that there are equity-like characteristics in credit-oriented bonds, but I think that the opportunistic fixed income portfolio, as it will be proposed, recognize that what we were looking at in historical time periods were passive indices. And so we would expect also that there would be some active management value added, including protection on the downside. But that's key to the, I think that's key to the expectation of performance for that individual asset class.
We'd also point out on opportunistic fixed income, while you have here the proxy as triple Cs, the managers probably would be buying securities that are more senior in the capital structure, and also probably wouldn't be buying the triple Cs that were written with what are so-called covenant-light provisions.
Until they got cheap enough.
Until they exactly, until they got cheap enough. But that's the point. They wouldn't be buying them just as on a new issue basis.
You hope.
Right.
Yeah, Mark, we've had 5 pages of when everything went wrong, and of course you didn't follow it when it came back. I mean, I look at those graphs and I say, yes, equities go down when equities go down. It also suggests to me rebalancing is good.
Absolutely. Rebalancing is always good.
But that, I guess, as you're suggesting, is the goal is to try and smooth the total result as opposed to necessarily clip the performance of any individual component. And that's really a balancing act. You can write it when it's wild and just rebalance and take advantage of these things, but accept the consequences, or you can try to smooth it out a little. I think most people are comfortable with smoothing it out a little, but...
Well, Bob, no, I think to be clear, what ultimately we're proposing here is a balanced asset allocation that in fact rebalances as you do. That is meant to get to the smooth.
Yeah, I'm sorry, yes, no, you rebalance regardless, whatever is chosen. But you're trying, and your end result will show that you're trying to reduce the overall volatility of the portfolio year to year, even if on the margin.
Correct.
Yeah, so the point is not to say that equities are bad, because as you point out, these are time periods that are specifically chosen to show when equities are bad, how do other asset classes do, with the recognizing that we need to have equities in the portfolio. We need to have a significant amount of public equities in the portfolio. How can we mitigate some of the risk associated with those equities in the portfolio?
It also reflects the skewness of returns. There are far more periods with sharply negative 3 standard deviation events on the downside than on the upside.
Certainly then it would be predicted in assuming a normal distribution of returns. Yes. And I think that we've pretty much covered slide 12 in terms of the remarks that we've made now. The next couple of slides talk about the optimization process that Mark referred to earlier. We're really just trying to, on a mathematical basis, for a targeted rate of return, minimize the volatility, minimize the risk associated with these portfolios. And we can do that, as I said, we can do that mathematically, but one of the things that is missed in the course of that process is what actually Ranjan just alluded to, is we're making some assumptions about the range of returns, and we realize that there's some oversimplification in that. And so consequently, there has to be a qualitative overlay to this quantitative process. And the way that we would propose reflecting it in our analysis is to put some constraints on different asset classes to say that we recognize that these projections are as close as we can come on a quantitative basis. We know there's some other factors that can be involved, so we're going to try and mitigate the risk associated with those other factors. Some of those factors are reflected on slide 14. On the left-hand side, bless you, on the left-hand side are exposures that we need to have in terms of capital accumulation. As we just mentioned, we need to have equities in the portfolio in order to build sufficient returns. We need to have diversification in the portfolio. The mathematical process tends to take into account these issues. The qualitative issues tend to be on the right side. Minimize volatility. We know that when equities do poorly, there's this flight to quality, so bonds do well, as we saw historically. We want to generate alpha, that's the active management component, and we want to be cognizant of the potential for oncoming inflation, and so we want to have exposure to that. There's no good quantitative way to incorporate this. As you can see, that asset classes play multiple roles, but we want to, in the course of the quantitative evaluation, address these issues in the implementation of constraints. The next two...
Actually, yes. I have a question about the slide on page 14. I guess we've heard from a couple of managers recently about I believe what they're calling multi-strategy investments. Where does that appear on either of these?
Like the Bridgewater GMO.
Yeah, I think the difference are what multi-strategy type of program attempts to do is to take these qualities of the different asset classes and balance them in a way that's associated with their subjective probability of when these asset classes might be useful.
But aren't they distinct from, aren't those types of investing strategies?
Al, I think
from what's listed here?
They are. I think what I would tend to view those as, again, implementation as opposed to an asset class. In other words, I'm not sure I would say that that type of, opportunist, or, those types of investments that we saw are necessarily like U.S. equity or private equity or high-quality fixed income. I think what it is, it's an implementation tool that they use to invest across the board. And so to some extent, they may give you exposures across all of this, depending upon how they invest.
That's what hedge funds.
Well, in some respect, that's correct. So in some ways, it's not dissimilar to the alpha generation or diversification that you see hedge funds fit into. I don't know about the lower volatility. I may argue with that one a little bit off of some of what we saw. But I don't think they fit as easily into here.
And also, we're excluding the use of derivatives to get exposure here, which can be the case in some of the multi-strategy.
Right, yeah, they're hedging things.
Yeah, they're hedging things and they're leveraging. They can leverage as well.
If I can take a shot at that, Al, I think they try to use the maximum opportunity set, which is everything on this page, to try and get to what this analysis is also trying to get to, which is maximum return and minimum risk. So it's how they put these portfolios together, which asset classes they use, and how they change that over time. That changes from manager to manager. So some of them use the entire group of asset classes here. Some of them use just a handful of these. GMO used only about 7 or 8. Bridgewater uses up to 66. So, but the goal is what Mark and Jim are describing, which is there a more efficient portfolio that allows us to get high returns and for the lowest risk possible? Would you agree with that characterization?
I'm going to go very quickly to the next two slides. The only thing I want to point out on slide 15 is that when we come up with expected performance for the asset classes, it's on a 5 to 10 year time horizon, so it's a very strategic time horizon. On slide 16, the real takeaway from slide 16 is that we don't just extrapolate historical performance when we come up with our performance expectation. We do look at history, but we look at current market conditions so that we can reflect all the information that's available in the market in coming up with our capital market expectations.
So Jim, this was a question I had too, which is how much is this influenced by current valuation rather than history? So the relationship, you looked at one equity bucket, but, on the fixed income, you're more granular. How much do you recognize that high yield spreads are really tight relative to what one might think is normal?
I think very much so. I think, when Larry alluded earlier to the fact that the equity market appears to be fairly valued given the high level of profitability, that was something that we took into account, in addition to the fact that, we didn't really see an appetite in the market for risk assets that would lead to an expansion of valuation ratios. So I think we try to get that's an example of us trying to get as granular as we can in each of these asset classes. And we'll do that for large cap, we'll do it for small cap, we do it for developed non-U.S. markets, emerging markets, and so on.
But Roger, I think maybe I'd add to that on the scale of various firms that do the type of work that we do. I think among competitors, I think we would tend to be more strategic, less tactical in that regard. I think certainly relative to what you would have heard from Bridgewater and GMO when they came in, GMO I view as much more strategic than Bridgewater, who operates, a little bit more tactically. But I think even with respect to GMO, we would be longer-term strategic as opposed to tactical. So I think along the scale, that's how you would place us.
So as a result of that process, on slide 17, we show all of the expectations. There are clearly a lot of numbers on these pages. This page, I won't go through them all. Most of these are our standard expectations, with a few exceptions. The core plus 5 expectation is custom for NYCERS fixed income portfolio. The opportunistic fixed income expectation is a custom expectation, and we modified the hedge fund expectations modestly to reflect the way that your portfolio would be implemented. So that's the kind of the joint nature of the Callan and BAM assumptions, but I would certainly say that while we work with BAM, we're completely comfortable with all of the expectations that are included here.
So just a couple of thoughts, questions. One is opportunistic. Here, our other two consultants that we've seen so far model them equity-like in terms of vol. So very surprising numbers here for me in terms of 975 vol. Again, we're still buying 4 or 5% everywhere, so it doesn't change the outcome of the mix. But in terms of risk, I would ask BAM to calibrate that number, because we have very different numbers now from our consultants. In an asset class that inherently nobody knows a whole lot about, so admittedly, okay? And then I would really urge Callan to separate out emerging markets. I am flummoxed as to how to think about emerging markets, because they have private equity, they have 30+% risk, which is very distinct from the 18-19% shown here.
Yeah, and actually the global ex-US portfolio is the equity ex-US portfolio, right. So there's about a quarter of that in emerging markets. We do have a separate emerging markets projection distinct from both this and the developed markets projection. I think the motivation here was that we had a lot of asset classes. We tried to simplify where we could. If it's of interest to break that out, we certainly can do that.
Okay. Yeah. It would be to me. I'd leave it to them.
And Raji, I guess to the first point, I recognize that the volatility for opportunistic is lower than you might have seen. My guess is also, though, that our correlations, as we look at the correlations to equity, may be higher than you've seen.
They've gotten up there. So NEPC was 0.9, and Rokutan is at 0.7, maybe going to 0.8. Yeah.
Yeah. Okay.
Yeah, and this is a combination of the lower grade bonds. It's a combination of high yield, which probably speaks to the correlation that we were just talking about. There's emerging markets debt here, and there are bank loans. Okay. All in into this.
And then we didn't model convertibles, and thank you for that. You explained that. But REITs.
We had some early discussions about REITs in the early conversations. We tend, and this is our tendency, I think, to view REITs more as part of a real estate allocation than as a separate equity type of allocation, and so from our preference, and we recognize we're not the real estate consultant here, and I think that's a separate question, but we would tend to view real estate or REITs as a way to help implement a real estate portfolio, and one of the reasons is exactly what I think this fund is going through, sort of a difficulty funding up. It helps you fund and get the exposure to real estate, recognizing the market-like risks associated with it. So that tends to be our preference. I don't think, after those early discussions, I don't remember, and whether it fell off the table, I don't think we talked much about REITs as a separate asset class to model. That doesn't mean we can't in the next go-around.
So, Larry, something I urge us to do, because we're having real trouble getting invested in direct real estate, the REITs in the other portfolios have been quite helpful in getting us some of the exposure we need. They have this hybrid characteristic, which is diversifying within an equity bucket.
We should talk to our real estate consultants about what they think about REITs, as well as our general consultants.
I don't think I've ever heard our real estate consultant express a point of view.
That's why we should talk to them. You have your general consultant saying it's real estate, you have your real estate consultant not talking to you about it, something is clearly amiss. It has to fit somewhere. And when you have your two main consultants not agreeing on what it is, I think that's an issue.
Well, you're saying you can pull it out, you just didn't.
We can,
Oh, but he said it was real estate, and your real estate consultant says it's not. Well, that's not very productive.
Well, I think in this case, we can ask Callan to at least model it, just as we can ask you to model emerging markets and still have that other conversation, is what I'm hearing.
We'll have more discussion about REITs with our real estate consultants.
Okay, page 18, and we're going to focus page 18 really easily here.
Let me make one comment before you leave this page 17. So 17 looks extremely scientific, and I think you put it pretty well when you said you should take it all with, I forgot what nice word you used, but it sure rang well with me. I don't know if it was a pound of salt or it's imprecise or judgment. I think the word was judgment. I mean, page 17 looks like science, and the reality is it's art. So you're about to go from science to art, and we shouldn't, as much as these are interesting numbers, they're directionally correct, as I think Larry Carey pointed out, on any, or maybe it was Pat, on any day, none of these numbers are right, and these are all long-term smoothing of very volatile things. So the devil is in getting it from science to art, and then getting the art into practice.
And if I could add to that, though, it also helps, as inaccurate as they can be, they're consistently inaccurate. So I think what really helps there,
Therefore, they're right.
Sometimes
the double
they're But what I really think it helps is that, as Larry says, they're probably in the right direction. It really helps for comparisons across mixes. I think that what we say is a higher returning mix probably is a higher returning mix. What we say is a more volatile mix probably is a more volatile mix. So in terms of comparing the relative performance of these asset mixes going forward, they're probably a pretty good indicator.
Okay, so on 18, now we're really going to get down fairly simple. Remember we talked at the start. The objectives we came to out of this is let's target a return similar to where the current portfolio is targeted. Let's diversify it further, and let's implement it in a way that makes as much use of the basket clause as we can, and recognize that we are beginning a process here of step one. So at the risk of ignoring half of the page, I'm going to ask you to ignore half of this page on 18. And throughout the next number of pages, I'd like you to focus in on the left-hand side that's called target, and that represents your current asset allocation policy. And on the right-hand side, that's called BAM. What that shows is what ultimately the recommended portfolio that we in BAM are bringing to you today. As you go down that BAM portfolio and take a look at what's called the 10-year geometric mean return, you see that shows up as an expected return of 7.33%.
That's 7.4 for the target?
No, this is for BAM.
Okay, I'm sorry.
Okay, 7.33. And then if you go way over to the left to the target and see that the target portfolio has a 10-year expected return of 7.4. So similar levels of expected return. If you take a look at risk as measured by standard deviation, you see a lower standard deviation. If you take a look underneath that at total non-fixed income, so essentially anything that's not fixed income, you see that we have reduced or increased the amount of fixed income in that portfolio. If you take a look at the basket clause, we've maximized the use of basket clause from 17 at a policy level to 25%. The portfolio becomes somewhat more illiquid, and what we're talking there in illiquidity are assets that you cannot get your hands easily on. You can't easily cash it in if you want. And so part of this is needing to make sure you have sufficient liquidity to meet your benefit payments.
And I have to interrupt Mark there. There is a typo on this page, which I will summarize as the total illiquidity for the target mix is 17 rather than 14. So we're not contributing between the target mix and BAM, we're not contributing 5.5% more illiquidity, we're contributing 2.5% more illiquidity.
Can you define level 1 and 2 first?
Yeah, level 1 is the real estate and private equity investments, and level 2 is half of the total of hedge funds, high yield, and opportunistic fixed income. So 1, total real estate and private equity. Level 2, half of hedge funds, high yield, and opportunistic fixed income.
So the illiquidity level 1 should be 11?
Yes.
And the other one should be 6.5 then?
No, under target, I think it's 11 and 6 for 17.
Oh, I think it's 17.5. 17 even?
17 even.
17 even.
Okay.
Then as you go down further into the bottom box where we talk about the public equity risk and public and private equity risk and opportunistic risk, which we've broken out, the risk associated or contribution from the opportunistic fixed income investing, you see a fairly substantial reduction in the public equity risk, a reduction, although not to the same degree, in the amount of total public and private equity risk. So you see a reduction in the risk of the portfolio associated with investing in equities. It is not as far as it may be if, in fact, returns were more in an equilibrium state. But again, it's accomplishing that to the extent you can, given the rest of the objectives.
Now, in all due respect to all these numbers, that's a little bit illusory, right? You have stock market risk. You could just hide it in a private company. The value is still bouncing around with the stock market. We just happen to call it public equity risk versus equity risk, right? It's still the same risk.
Well, although again, I think...
Just call it different, I think.
No, it is. We do call it differently, Larry, although we do have and that's part of why what's called the public and private equity risk, which includes the risk associated with the private equity investments, et cetera, is not reduced to the same degree that the public equity risk is.
Right.
So...
Better number.
Yep. No, agreed. Agreed. So then as you go up in that to the comparison of the two portfolios between the target and BAM, where do you see major differences? As you look at broad domestic equity and to a lesser extent global ex-US equity, you see a pretty substantial reduction in public equity exposure. As you go into high yield, which is an area that you currently have a target of 6%, you see that being reduced to 4%, partially because of how the view of high yield is currently, but also partially because you're introducing an opportunistic fixed income investment where you currently don't have a strategic allocation, although you're invested in that area, up to a 5% level. And so the risk exposure in opportunistic includes some of what is coming off the table in high yield, but it's also being done in a much more opportunistic way than simply a target allocation. You see real estate staying the same, even though it's been a difficult area to get funded. We still believe real estate is a strong diversifier. You see hedge funds being introduced at a 4% level. and you see private equity increasing from the target of 5% up to a 7% policy, which actually is right about where you are currently anyway. So equity money coming off the table, an increase or new asset classes in opportunistic and hedge funds, which are both areas that are heavily reliant on manager skill, and give you some blend of both equity and fixed income characteristics in both, and continuing the diversification in all the asset classes. Larry.
Just to plead ignorance, core plus 5 refers to what exactly?
That's your high-quality fixed income portfolio that you currently have.
What's the plus 5?
It's actually, people get confused by this. It sounds wrong.
It's actually core less 5.
Right. Core fixed income traditionally refers to investment grade as defined by the Barclays aggregate.
Okay.
Governments, mortgages, credit. We take those sectors and hire sector specialists. And what we do in addition to that is create a longer duration benchmark by removing the 1 to 5 year Treasury and agencies, because those are the lowest expected return securities in the universe. So the core plus is generally referred to as core fixed income plus something else like high yield or emerging market debt. In this case, the plus is removing 1 to 5 year Treasuries. So we call it could be called core minus 5, but it's called core plus 5 because of the usage of core plus in the industry.
So it's core absent the short term.
The Treasury bills, right.
But only treasuries?
Treasuries and agencies. And that gives you a longer duration in the portfolio as well.
How would that compare to a standard intermediate duration?
It compares to the Barclays aggregate. Typically, you get a higher yield, and you typically get higher because you get higher spread product, and you have a longer duration. So over time, in investment grade, the thesis has been, barring defaults, which you generally don't have in investment grade, yield wins. And if you look at the record versus, we can do this some other time, versus the Barclays aggregate, the index generally does better and the managers add value over that. So it has done well.
Yeah, on the basket clause, a couple of things. First, I was comparing on the target portfolio your basket clause of 17.6% versus what's shown on page 102 of the big book, which is 18.1%. And I think it would be important to reconcile that. Second, picking 25% as the basket, given the volatility of markets, even though it may take a long time to get there, would seem to be a rather aggressive policy statement.
I think we took the assumption we're going to change the law next year.
I'm not suggesting that the approach isn't right, but I think when it comes to adopting a policy, if anything is this close to an existing legal benchmark, then it just ought to be, this is where we're going to, we won't pass it, we'll stop when we get to something that just makes it clear that you're not intentionally designing something that would probably fail. That's my suggestion there.
So Bob, as far as the basket goes, in the back of the book, we show that we have by policy 18.1, and here he's showing 17.6.
Right.
That's due to an estimate that we used for, I believe, TIPS, where we have some non-U.S. inflation-linked securities at 0.5% that we estimate. That's the difference.
Right, and so in your model, you assumed everything would fall in the approved, like in your modeling. Okay, that explains it. And if I might just ask for the benefit on page 17, just to be clear, one, all the returns and net of expenses?
Yes, they're passively.
Yes, passively implemented net of expenses.
And second, the underlying consumer price inflation?
It's 2.5%.
2.5%, thank you.
So target versus BAM is where we focus down to. The following number of pages, I think, and we can do this in really just a half minute per page, but I think what we've tried to do in those pages is take a look and say, all right, both in those past market crises, through optimizations, and then for the past markets as a whole, how in fact would the target and the BAM portfolio have performed? In other words, in the past, would they have benefited? In the future, from optimizations, do they show an improvement to some degree in expected downside? And can you tolerate that level of potential downside? I think all of that is meant to sort of wrap around to ultimately get to, okay, here's the recommendation of both BAM and Callan, and then how does the board feel about that? Are we set to go on that? So, Jim, maybe just like I said, a half a minute on each of.
Because we can.
I'd like to come back to the allocation because I have some comments, but please go ahead.
Yeah.
Okay. If you look at slide 19, we're going back over the problematic equity markets historically. On 19, we're looking at the 1987 stock market crash. The existing target portfolio is the blue bar on the left. The BAM portfolio is the green bar second from the right. And you can see that the BAM portfolio would have outperformed by about 2%. On slide 20, you can see that it's the same setup. This is the first Iraq War. The target portfolio down almost 8%. The BAM recommended portfolio down about 6.7%, so an improvement of about 1.3%. On slide 21, long-term capital management, Russian debt default, end of the Asian contagion. The target portfolio down almost 9.5%. BAM down about 8.3%, so better than a 1% improvement by the BAM portfolio. On slide 22, this is the bursting of the tech bubble when equity markets did particularly poorly.
And Enron.
And Enron. Want to give credit where credit is due. The target portfolio down more than 25%. The BAM portfolio down less than 22%, so about a 4% gain. And then finally, through the downturn in 2008, the target portfolio down almost 37%. The BAM portfolio down less than 34%, so about a 3% pickup. So historically, in all of the periods that we looked at, because of the reduction in public equity exposure that Mark alluded to on the asset allocation page, the BAM portfolio has performed better than the existing target portfolio.
And would it be fair to assume that on the snapbacks on the other side, you'd have a similar mirror image, but that overall, by having less down and less up, the whole portfolio is more stable?
Bob, I think that's a tremendous bridge to page 27. Thank you very much. because again, I apologize because we've focused significantly on downside, right? For a few reasons, but one of them is because I think this board felt it was important. How bad did things get, and at least in the past, would we have done better with this? That's not a predictor of the future, but it's something to look at. So the last thing in terms of that, we're now going to get away from downside only, and let's get to historic over the past 20 years. How would these two portfolios have done, both in absolute terms, in volatility, and then in risk-adjusted performance? And so on page 27, again, focus in on the BAM portfolio, which is in the middle. And what this is meant to say is what has been the average on a rolling 3-year basis for the last 21 years through December 31st, 2010, of these two portfolios. So the BAM portfolio at 8.61, your target portfolio at 8.45%. So an average of 16 basis points excess performance over each of these rolling 3-year periods is attractive. Where it really shows forward is on page 28. which is the volatility of those returns. Your current portfolio, which is heavily equity-oriented, not diversified to the same degree that the recommended portfolio is, shows an average standard deviation over that period of time of 977 compared to that BAM average portfolio of 8.89%. And so it would not surprise you then on page 29 that the risk-adjusted performance, and we happen to choose Sharpe ratio here as the measure, that the risk-adjusted performance of the BAM portfolio is significantly higher than what it would have been for the target portfolio over that time. So what we've tried to do is take a look at the combination of quantitative and fundamental, the combination of past as well as projections for the future, combined with the goals that we talked about, and ultimately come to what we talked about earlier, and that is, and I know Raji wants to get back to this on page 18 now, the portfolio that's shown there as the recommended
I
portfolio.
just want to make a couple of comments on what you just said, because it's actually quite important, right? Which is, in many ways, one likes to think as a board that you always have the most efficient portfolio at any time. Except over time, markets change, valuations change, and the opportunity set changes. So what we're seeing here is for the same returns, we can actually reduce our risk and get a better risk-adjusted portfolio. Those opportunities are not supposed to exist in the capital markets, but to me, that's the value of this exercise, and that's why you look at it a little bit more frequently, perhaps, than we have historically in a more systematic way. The second question I have is on page 26. I would like to see if you guys, for a 5 and a 10-year period, can add the median number as well. So not the top 5th percentile, because we can't plan for that, but the expectation, which should be around the numbers you have, but this is the 5-year, and I'd love to see the 5 and the 10.
Sure, absolutely.
Which should be around the 7.3 is my guess, but it would just be helpful
Yeah,
to...
it will be very close to the 10-year numbers shown on slide 18,
Okay, even for the 5-year?
even for the 5-year, because it's
Okay.
compounded out enough that it tends to be, it's asymptotically stable, so.
Okay.
What?
Right, like you said. Like you said.
Well, on that, just on the model, did you use a normal distribution, log normal, Pareto, stochastic? What exactly did you do to get these percentiles?
It's a normal distribution. It's simulated quarterly, 5,000 simulations, so it's a Monte Carlo structure. And we compound those out. We calculate the geometric mean returns for each of those simulations. We take the average of those to get the portfolio.
Right, and the quarters are linked all with the same assumptions
It's
throughout
right.
the period, as
Yes.
opposed to something varying due to the effect of inflation adjustments and so on.
That's correct. All the parameters for each quarter are the same.
Thank you.
So I would like to go back to page 18, just a few comments, and this will sound like deja vu to BAM, but a couple of points. One is the emerging markets matters to me because I am reluctant to reduce the global ex-US weight by reducing emerging at this time.
Right.
I think, Larry, we're aligned on that one, but because you don't break it out, it's a little hard to see from this, but I think the board has a policy target 13 and 5, and I'd like to get that granular, just so that we are consistent with the way we currently look at the portfolio.
We can do that.
My second observation in terms of commodities, just as going back to that, is the only, Larry has included staffing for it. Our hope is that BAM will come back with staff and a plan, because the last time you presented to us in February, they can play a very valuable role in this portfolio. But we just need to understand it better, because in fact, as you showed, it had even higher volatility than equities. So one can't jump into it without a plan. That's the only reason you didn't.
We didn't include it this time around primarily because of the discussions that took place at the last meeting. That's right. We
Right.
didn't think the board was ready for it at this point.
Also a longer term, right?
Yep.
This is the shorter term.
Right. exactly.
Can't execute on commodities, yeah.
Right. Well, there's a lot to execute on here anyway. My other question was, in presenting hedge funds, and I guess we are about to hear the opportunistic, it is clear that that 9% allocation is also not a one-year time frame investment, that looking at managers based on realistic staffing issues, et cetera, decision-making. And so I would be very interested to be very concrete about how we invest the dollars while we're waiting to get invested in those asset classes. Right. Historically, I've also been very concerned that real estate, which is not equity risk, is invested in equities while we wait. Right. So we have historically equitized our allocated but not invested dollars and taken on much more tactical risk than the policy portfolio could ever have suggested. So as that middle bucket is growing, this is the not equity but not fixed income, it's quasi A and B, I would really like us to be very clear as a board as to what we would like and would look to BAM and consultants for a recommendation on how to invest the dollars.
Agreed.
In particular, I also would like us to think, because at another board, a very persuasive case was made for emerging market debt. And that has not been included in this analysis. I have not studied the asset class. I don't know what valuations are. We expect to learn more at the other board. It would be very helpful, Larry, to think about it, whether we think about it opportunistically, tactically, as a strategic allocation. Callan, is there a reason, Mark, you don't model?
Well, again, I think it was a combination of a lot of things in this case, Ranji. From the start, we sort of had a wide range of assets that we talked about. I think we talked a little bit about emerging debt, but it wasn't at the, there was a lot of things going on, and it never got traction as what would be a clear recommendation. I think the second thing that played through was, as we viewed opportunistic, and again, BAM may not be on board with this completely, we actually think that within the opportunistic fixed income category, there may be some emerging debt exposure. That doesn't mean a strategic exposure, which I think is what you're talking about here. And I think we also thought again that I think we weren't sure how it may play out with respect to basket clause, with respect to implementing it now, along with implementing a number of other things. I think it just sort of fell out at that point. I think it's an asset class we see in perhaps the next iteration, but it just didn't have the same. We didn't feel as strongly about it as we felt about some of the others.
Actually, that's fair, the basket clause point, because I think in the other board, because they don't do hedge funds, we could have potentially used emerging market debt. That might be a constraint here. But again, I'm assuming you had to model emerging market equities for the basket clause. So the question is, what if you can just break it out in the analysis? It would be very important to see.
Sort of whether the optimizer may like emerging debt versus one of the other basket clause issues. Right.
And I still like it as I think the opportunistic construction is interesting, because opportunistic, I'm assuming, is 100% in the basket clause. So then EM,
opportunistic is not, no.
50%.
We estimated 50%. There are many cases where you use publicly traded registered securities.
Okay. But to the extent that we have 5% and you think you can do 2.5% over the next couple of years, and we can use that cash allocation to do something like emerging market debt, that might be an interesting way to do it.
It might. We actually had a lot of the discussion we had with BAM was from how quickly things can get implemented, and I think BAM felt strongly that they can get the opportunistic fixed income, the hedge funds to work in a relatively quick basis, because that was part of the discussion we had also, is being able to get it to work, how quickly, and so forth, and what does that mean for other asset classes. So there was a pretty strong feeling that those can get to work pretty quickly.
There is an execution time factor that's not in here. We've approved the corpus expansion ban. I'll have to wait until those people actually show up. But if you look at the RFPs that BAM is working on now, they're working flat out. And even though we have this new process which will accelerate things, I think if we can get this done in the next couple of years, that'd be great. And during that period, introduce a couple of new classes like emerging market debt. But I think this is a very aggressive plan actually to implement, given the resource constraints that we have. And I do believe that, we'll come back annually, review the asset allocation to the extent that it moves around, it'll move around. And then ideally, again, the other factor is we do get to hopefully change a law in Albany, which, takes a while to get done. Ideally, it's next year, but as we approach the basket clause, and I'm not quite sure what direction it comes from because that falls back into the execution of what are you doing first. We do have room in the basket clause, as you can see here. So I think over the next couple of years, we'll get toward the end of this. We'll throw in emerging debt somewhere along there. We'll get through the basket clause, and then we'll look at this prior to that and say, all right, now what do we want to do? Where do we want to take it? But on an execution basis, this is a full load for BAM to execute this. I don't want you to minimize the execution of this because it goes investment by investment. So, and again, talking to Callan, we think we can execute the opportunistic fixed income in the hedge funds, but it's probably going to take us 2 to 3 years to actually invest this capital like that. So during that period, we can hopefully staff up and get into other asset classes, but when you layer on things like commodities or emerging market debt, it's just more complexity. The staff, you need different staff for that, which is in the plan, right? It's all baked in the corpus plan that we have, but there's moving parts to all this, right?
I think the issue with emerging debt, though, is that there's a window. And it seems like it's very similar to what's happening with, opportunistic.
If there's a window, some of our opportunistic guys will hit it if there's the window you say there is.
Well, my thought was we're going to do an RFP for New York City anyway, for one system. Is there a way to piggyback?
Well, once we get to that.
Right.
That's not...
That may be fall and spring.
Right, that's later.
But it should it be approved as part of this so you at least have a sense?
I wouldn't worry about it yet. When we get to that, we should look at this and figure out where it's coming from, because it will come from somewhere. We and the other board have absolutely no knowledge of emerging market debt yet. So to put it in here is sort of...
But it's in that board's policy, just for the record.
Yeah, it's a little bit ahead of ourselves. We should walk a little further before we do that. Again, I don't think we'll put it in until we review this in a year or so.
It's in the teacher's policy recommendation.
Yeah.
Anyway, Pat.
At one time, we had discussed infrastructure, and it's not part of this at this time, but is that something that later on would be included?
Yes. The simple answer is yes. Again, if you look at the corpus plan we approved, there was a couple of people for infrastructure. But it's not in the near-term execution, just because I need to first find some people, and we're working on the people.
Well, wait a minute, Larry, are you saying to go to even consider emerging market debt, we would have to staff up for that?
I think Martin and Addie are working as hard as they can possibly work on the backlog of initiatives that they have. We're actually hiring somebody in the next, hopefully, month to help them out, but I think people are pretty flat out for new ideas for NYCERS. To the extent that we slowly start to add something new, again, it's I think we're starting to push the execution. There's so much we can do at a time. If you look back on what we've done in the last 15 months, it's actually been a lot. But I wouldn't want to overpromise and underdeliver. For fixed income, getting opportunistic fixed income up and going does actually potentially touch emerging market debt. Might. But we have work to do.
Is there something we could do with guidelines that allow space in the basket clause for something and then let our active fixed income managers make that call? But just permit it? I mean, sometimes it may not be,
You have to go to some, it's within some IPS. We got to start there, right? We don't, the word emerging market debt doesn't appear in anything we have.
but an IPS change may be easier than an RFP. Meaning
Well, no, you
if
gotta-
you
I
can
mean-
broaden someone's guidelines.
There's no manager we have today that doesn't.
Right.
That's the
PIMCO,
oppor-
BlackRock?
No, they
Core
have
Plus?
completely different.
Because they have the,
they're buying-
within corporates they come to?
There are Yankee bonds in the corporates. It's mostly developed. There are some emerging, but it's all dollar denominated.
Right, but if we broaden guidelines?
The procurement police would say you just crossed an RFP,
By broadening guidelines?
perhaps to that extent.
Yeah, the benchmark
Oh,
has
let's talk to procurement police.
And the other thing about the other board, I think we need to check to see if EMD was in the 35% case, not the 25% case.
It's in the 25% case.
It's in the 25% case?
Yeah, without hedge funds.
Okay.
So anyway, we'll work it all out there.
Larry, your staffing constraints trumps everything else.
Right.
So there just goes without saying. But if there are ways to be creative around guidelines, or if we think the exposure matters, we haven't studied it yet here, so we don't know that from NYCERS. I would still be open to studying it and learning about it, and that itself could take the board several months, just in terms of sequencing.
Right.
So maybe we can schedule a study session or trustee education session, and then just keep working, keep thinking through other ways of maybe getting the exposure as we learn about it in other places.
Fair enough.
Okay.
So, Mark, what I'm hearing you say is that you think the BAM allocation here is optimal?
The terminology of BAM was just a way to sort of, it was easier than putting BAM Callan. But yes, this is the proposal that we've come to in working with BAM in terms of what we think is a good policy for this board to adopt.
Right.
It is a joint thing. It's not just
No. Yeah. So what I'm saying is that there were other, I assume there were other iterations that you did that might look different from what we have on the
There were a number of iterations starting a year ago through February and then after February. So yes, there were.
It's measured in 3, possibly 4 digits.
And so, with respect to multi-strategy, I think I'm still trying to get my arms around that, because I thought multi-strategy was a strategy and not a asset class. It was a strategy.
You mean like the Bridgewater GMO type of things, Al?
Right.
Yeah.
Or
There's
even,
multi-strategy hedge. The multi-strategy I think you're thinking of is within the hedge fund number. Is that the multi-strategy? I can't tell you what you're thinking
He's
about.
talking about Bridgewater GMO.
The TA tax
Al,
allocation?
Yeah, it's like TAA.
That is not something that would be modeled as part of asset allocation at all. That would be a separate decision. The board could decide that in implementing in hiring investment managers, you could, as a board, decide we want to hire multi-strategy managers, using that term, similar to what you saw. In order to do that, the decision would need to be made, where do you pull assets from? You could think about it potentially from hedge funds. You could think about it as simply a carve-out of the entire portfolio. But I don't think that really is not part of this decision now.
Right.
Janice?
So this is a living organism. As we change it, it will change.
And just another way to think about that question, what some boards will do is to have an opportunistic allocation from 0 to 10%, let's say. So while we're thinking of opportunistic strictly in terms of fixed income, other boards may broaden that, and TMA could fall into that category. So that's another thing for us to think about.
Yeah, I mean, yeah, to give us more flexibility. I think that's been one of the things on this board for a long time, is that it takes us too long to do things. And we've come up with a lot of, I guess, gadgets to try to help us, such as the pools, such as, I mean, this would, such as, expanding the ranges of the investments. I don't know. I think we need to have maybe we need to have a conversation on that investment strategy sooner rather than later. I was very impressed with what I saw from those two investment firms, and I'd like to see us investigate that sooner rather than later.
So I think Mark is right, it is implementation. What I think the point you're getting into, which is something that Larry and I talk about all the time, is the policy portfolio can be an albatross, because you can be overweighted something and then you just sit with it. What is really interesting about GTAA is that these managers are specialists in trying to figure out valuation. Doesn't mean they get it right? You have to be extremely patient with these approaches, and that's something else that's going to test this board, because when you make a bet, and if in 1999, if you sold equities to buy bonds, or GMO said they were, 50% cash right now? I don't know, that's been one heck of a losing bet in the last 9 months. So again, and there are lots of managers beyond the two we saw, but I think Mark is exactly right. It turns into implementation, but I think it fits into this broader opportunistic discussion, which I too would like to have. I think we're putting a lot on BAM's plate. I think we haven't finished this. I think we need to get through a bunch of this, the questions coming out of here first, but I think it would be good to sequence that in.
Any more questions on this asset allocation? What we're trying to do is get this approved by the board to get to the next. End this for now, although, I believe asset allocations at every board meeting, that's why I put the slides every meeting, so we can talk about it perpetually and keep changing it, but...
Well, I don't think we got all our questions answered just on this mix in terms of a couple of granular questions, right? So
you think that would hold up the process, the granular, but those little questions?
You tell me.
I would think it's good to go.
Yeah, I mean, I guess... I think the policy itself, again, from our standpoint, is one that we're comfortable recommending. We think you could adopt. There may be implementation. The issue, for example, of emerging versus developed is something that we could certainly run something pretty quickly to show an optimized version of that. At the same time, we talked about that earlier, and ran it this way with the idea that it would be a strategic decision after asset allocation that would largely break out probably somewhere along the lines of what you said, Ranji. But we could certainly put a number to that very, very quickly. So perhaps approving this subject to that breakout is not going to change our recommendation overall.
That's fair. And then, Larry, you punted the REIT to the real estate consultant.
Yeah, we have a longer conversation about real estate with or without REITs, away from this. I mean, this is a number. The REITs fall into the execution, core, opportunistic.
I don't because...
Where does it fit? Because again, you have and we have an RFP going on for real estate consultants. Some of those people have different views on that. So I would tell you that the REITs is it's implementation. B, I don't think it's. Well, we have the board has to. We have to sit down and decide what we think about REITs. Which consultant is supposed to help us figure out where they go? It's not obvious. It's obvious to me, but it's again, the consultants of the board are right now pointing in two different directions, right, which is not constructive.
I think that I think that policy decision can be reached. I don't think that right now, if in fact we modeled with REITs, it would show a significant allocation. And I guess I would, wanting to put this, to get going on the main body of all of this asset allocation, I think this is worth adopting, and then include the REITs as part of immediately what we look at next time around.
Plus, as you
that
know,
doesn't mean it can't be implemented earlier than that. But.
As you know, we have an RFP for REITs right now.
Look to jump in.
NYCERS can always participate in that. I don't think NYCERS is in it, right?
No,
NYCERS doesn't do REITs, so we have to educate the board on what a REIT is. But we're in the process for some other boards of going through a REIT RFP. So this board has chosen not to do REITs in the past. So we have to have
Have you driven that? Anybody remember here? Because it's part of the policy portfolio everywhere else. I'm just curious.
I don't remember.
Okay, it's okay. We don't have to stay up. So I'm all right with if we can come back and agree on emerging markets, and then trustee education on emerging market debt and REITs and infrastructure, but sequenced as and when we can possibly do it. Well, before the next asset allocation conversation in the year, at least.
Right.
Do you need a
vote? Motion.
Need a vote?
What are we voting on? What are we approving?
So we are voting on adopting a new short-term target portfolio, which is moving us, as you see on page 18, from what is called target on the left to BAM on the far right, with all of the implications it brings in terms of going from 18% of the basket plus to 25%, keeping the same level of return and modestly reducing risk, and significantly moving assets out of the equity risk bucket into a more diversifying strategy, which is heavily focused on opportunistic credit and hedge funds.
Correct.
Would any board member like further discussion? Okay, then can I get a second? Anyone opposed? Could I also ask, in addition to emerging markets, to please come back on the allocation issue of cash and how cash will be invested?
Rebalancing, yes. So
And Larry, I think it would be helpful to also get a marker for if this is period 0 and it's going to take some time to execute. Could you lay that out for us as an interim or a 1-year marker, and where you'd expect we'd be, so that this is one of the things we're clear about is with staffing and governance. This is a 2-year type proposal. It would just be helpful to have some markers so we can see relative to our allocation. And that should be a page we have in our allocation once a quarter or something, so we see where we are.
All right, we have a plan. Again, it's fine, not a big deal. We have a work plan as to how we're supposed to execute all this. I'm afraid that it always ends up slower than it is in the plan.
Well, it's a discussion
Just
I'd
to
like...
manage everyone's expectations, including my own, especially my own.
It is a conversation I'd like to have, because to the extent that there are things the board needs to do to help you with that, we should be aware of what those issues are.
Right.
And Larry, these other issues too. Somehow, if you can work that into the plan.
The other issues.
Emerging market debt.
Oh, yeah.
Multi-strategy.
No problem.
Commodities.
So did we vote?
Yes.
Yes, we're lots of work. Thank you, Callan. Thank you very much, Ben.
Thank you all.
Thank you.
So for the record, it's resolution number 2.
So that ends the public session agenda as put forth in our agenda.